This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on trading breakouts. I'm going to begin by talking about bull breakouts, and then I want to talk some about by the close bull trends. Those are the strongest types of bull trends. The market is reversing up here, and it has a series of bull bars, several closing on their highs, and the bull bodies are getting bigger. It's obviously a strong bull trend. At the close of this bar, and you had 2 choices, which would you take? Would you bet that it's going to go down to this low? Or instead, would you bet that it would go that same distance up here? In other words, would you buy this close and put a stop down here, looking to take profits up here? Or would you sell this close and put a stop up here, betting that it would first go back down here? Clearly, the momentum up is very strong. The odds are, if it's going here or here, it more likely will go here before it goes here, and therefore the bull case is better. The reward for the bulls buying here is the same as the risk. Here's the reward, here's the risk. The bears who sell here, their risk is here, their reward is here. They have reward equal to their risk. So for the bulls and bears, both have the same risk and same reward. So they have the same risk-reward ratio. But when you look at this, the probability clearly favors the bulls. That means the probability is 60% or more that it's going to go to the bull target before it hits the bull stop. And therefore, with a probability that's high, 60%, it's mathematically okay to take a trade where the reward is equal to 1 time the risk. Here's the reward. It's equal exactly to the risk. But because the probability is 60% or higher, the math is okay. The trader's equation is positive. Easier to make money buying because the probability is greater, even though the risk and reward is the same for the bulls and the bears. One of the difficult things traders have is they're surprised by how quickly the market's going up, and they panic and they cannot decide, oh my gosh, it's going up, but look how far away my stop has to be. You have to develop the habit of being comfortable with that and trading appropriately small so that your risk is no greater than on any other trade. The most important thing is when you see it going up like that and you say, oh my gosh, I'm getting nervous. I know it's going up, but I don't want to risk that much. Buy small, just buy something, but you have to get long. And in this case, this is what followed. I'm always looking for signs of a strong trend. Here we have a bull trend, and therefore I'm looking for signs of how strong the bull trend is. Here we have a pair of bull bars, both closing on their highs. The open of this bar is at the close of that bar. The open of this bar is at the close of that bar. As soon as this bar closed, a lot of traders therefore bought the market. And you can see the pullback from that close is very small. The pullback from this close is small. The pullback from this close is small. That means as soon as the bar closes, more traders are buying than selling. Consecutive strong bull bars. By strong bull bars, I mean decent size or big bodies, and the bars closing near their highs. Closing on the high or only a very small tail on the top of the bar. That is a sign that the bulls are very eager to buy. Good buying pressure, and therefore when you see this and you look to the left, the context is good for higher prices. So you look at this, here's the context, a bull bar closing on its high, following a series of good bull bars. That is good context for the bulls, and therefore they'll buy expecting higher prices. What you don't see on this chart is the past several days, and this is what the past several days look like. This is where we are right here, and you can see we're at the bottom of a trading range, and we have an expanding triangle in a bull trend, so it's an expanding triangle bull flag. We reversed up here from a new low. We have a new low here, and we're starting to reverse up. This is another reason to buy. So if you saw the past several days, you would see that we are exactly at the bottom of an expanding triangle. It's important always to remember the market cycle. Only about 10% of the bars on any chart are in a strong breakout phase. Most 2 to 3 bar breakouts are part of a trading range or a broad channel. Only 5% of the bars on any chart are the strong breakout at the start of a trend, and that's what we have here. And you can see this, whatever you want, 2 bars, 4 bars, 5 bars, compared to 100 bars on the screen. Very important to decide early, and it's also helpful to anticipate. You see that we're reversing up from a break below a range. And if you look back at the past several days, you saw that we're at the bottom of a range in a bull trend. And therefore, you have to be expecting a reversal up. When you see it begin to happen, do not deny it. You have to try to get long as early as you possibly can. As soon as you start to feel that, oh my gosh, I want a pullback, that tells you that you have to get long and don't wait for the pullback. Here we have a pair of very big bull bars breaking above the high of the day, closing on their highs. Odds are we're going up for at least a measured move based upon the height of these bars. You could argue that we gapped down, we sold off, and then we rallied a little bit, and this is a bear flag. But here we're clearly breaking above the top of a bear flag. We're getting a bull breakout above a bear flag. The bulls are taking control. Strong follow through after the breakout. The close of this bar above the high of the day, closing on the high of the bar. And the second bar, now we have consecutive strong bull trend bars. The odds are high, 60% or more, that we're going up for some kind of a measured move. Minimum target is the open of the first bar of the breakout to the close of the second bar of the breakout, which is somewhere up here. Good context, reversing up from below yesterday's low. There are all kinds of ways to buy, and it doesn't matter which way you choose. All that matters is you have to get long. You have to choose one of the ways. And if you cannot decide, and you're starting to panic and saying, oh my gosh, my stop is far away, I know I need to get long, I'm waiting for a pullback. As soon as you start saying, I'm waiting for a pullback, buy. You know where the stop has to be. It has to be down here. So you just buy and you trade a small enough position so that you can put your stop down here. That's the easiest way to buy. You got 5 consecutive bull bars at this point. You're starting to form a 6th one. You can just buy at the market. Some traders will press their bets, which means they buy more, and they'll buy at new highs, betting that instead of getting profit taking at the new high, the market's going to go higher. That's another way to buy. So you buy the breakout to a new high. We have a strong bull trend, we pull back, the bull trend is resuming, buy above the high, buy above the prior high. You do that in strong breakouts. If the market is in a weak bull channel, you'll take profits on your longs at new highs, and bears will sell at new highs. But nowhere in this entire chart was the market weak enough for the bulls to be selling new highs and for the bears to be selling at prior highs for a short. You can buy the close of any bar, like a bull bar, but you can also buy the close of bear bars, betting that the reversal down will fail. You can buy above the high of the prior bar. Here we pull back for a bar. This high is above the high of that bar. You can place a stop to buy above this bar and you get filled here. Or you can buy a high 2 buy, 2 legs down, 1 pull back 2, and you have a bull bar. Buy on a stop above the high of this bar and get filled here. You can buy below a bar. Here's a second entry short. This bar went below that bear bar, so that's a first entry short. And now we have a micro double top, and this would be a second entry short betting on a failed breakout. But you know the probability is that we're going higher, and therefore it makes more sense to buy at the low of this bar, and you get filled right here, betting that the bear reversal will fail and become a bull flag, and that the bull trend will resume. You can buy a strong bear close, betting that it'll be a failed reversal attempt. When the market's in a strong bull breakout, it's spending most of its time at the high of the breakout. The market just keeps going up and up and up. And the beginners are always worried about risk. So if you're buying any of these opportunities, your stop is down here. And the beginner looks at that and says, wow, that's 10 points down. I don't want to risk 10 points. If you cannot risk 10 points, do not take the trade. But if you are able to risk the appropriate amount, in this case it would be about 10 points, then take the trade, because the probability is very high that you're going to make money and that you'll make a reward that's at least as big as your initial risk, and therefore you have a positive trader's equation. Some beginners don't buy, and they're hoping for a pullback because they want a smaller stop. So for example, some beginner might not buy any of this, and then they'll buy the high 2 bull flag and put a stop below the bottom of the high 2 bull flag. That's okay, but you ended up missing a lot of the trade, and it's possible that this pullback might not have come until the market was much higher, so you're risking missing a good trade. You don't get a pullback until experts start to take profits. Why would anybody take profits here? Because they bought down here and their stop is far away, their risk is big and they want to reduce their risk, and then they take profits. If the market does not reverse down very much, they'll look to buy again on a reversal up. For example, a high 2 bull flag, high 1, high 2. All of these entries look good enough for experts, and they're buying for any reason, knowing that all reversal attempts will probably fail, and that the trend might go a long way before there is any pullback. If you don't buy, waiting for a pullback, you might not get this pullback until the market is way up here, in which case you may have missed a huge bull trend. Even waiting until this point, you still missed a lot of the bull trend. There's never a reason to miss a strong trend like this. The market's clearly always in long. It's clearly more likely to go higher than lower, and therefore you have to buy. And when you look at this, you know where the stop has to be. It has to be down here, below the bottom of everything. It's possible that if you buy up here, you can put a stop below the 2-bar breakout or below the 4-bar breakout, but technically the ideal stop is down here. It's okay to use the tighter stop after you see this close, because if this is the start of a bull trend, probably 90% chance it's not going to come down below this 2-bar breakout, and therefore the math is okay to use that tighter stop. Stop either below the bottom of the bull breakout or below the bottom of the bull trend. If you buy late, I think you could also put a stop below the bottom of this 2-bar bull breakout. But to me, I initially typically put my stop down here. I'm not going to let the stop get hit. If it starts to reverse down, I'll get out earlier, usually. But I need a starting point, and to me, the best starting point is below the bottom of the bull trend. At this point, we don't know if the market's going to be in a bull trend or a trading range where the market could have a very deep pullback. We do know the odds are it will not be in a bear trend unless it trades down and trades up and gets some kind of a double top. And therefore, because of the possibility that this ends up as a bull leg in a trading range, you need the wide stop, because the trading range can have a very deep pullback, even below this low. However, it should not get below this low. It doesn't matter where you buy. You know where the stop is, and you can calculate what your risk is. You have to trade small enough so that the risk is acceptable. And if you're thinking about possibly adding on, if there is in fact a very deep pullback, you have to trade small enough so that the combined risk from your additional position is no greater than on any other trade. Let's say you bought the close of the second bar. Clearly at this point, the market has a very high probability of going higher and at least a 60% probability of going up for some kind of a measured move. Put the stop below the bottom of the bull trend, or possibly below the bottom of this very strong bull breakout. Or, as I said, you could also put it below the bottom of these two bull bars, because if your premise is right, that this is the start of a bull trend, it will not get below these two bull bars. However, as I said, it could drop below these two bull bars, and at that point, it would be in a trading range, and you don't want to get stopped out there because chances are it'll still come back up here. And therefore, that's really not a great stop. It's a good stop if you're only willing to hold on if it remains in a strong bull trend, but you're not willing to hold on if it's going to be in a trading range. If it drops below here, it's probably in a trading range. For some traders, they look at this and say, gosh, I really want to buy, but I can't risk all the way down here. I can't even risk here. Well, you can use a tighter stop. Typically, traders will buy a 50% pullback. Here's a very strong bull breakout. Traders will buy a 50% pullback. You could put a stop slightly below 50%, or you can say, well, this breakout bar is so strong, I don't want it to drop below that bar. And therefore, if you want, you could use a stop below the low of that bar. Whenever you use a tighter stop, you improve your risk-reward ratio. Anytime you have a better risk-reward ratio, what does that do to probability? It always reduces the probability of making money. Mathematically, it's probably okay to use any of these stops, but I think the best trader's equation comes from using the wide stop. You could use a money stop. For example, here's 5 points from here to here. You could put a stop 5 points down. Or as I said, you could put a stop a little bit more than a 50% pullback, a 50% pullback of this 2-bar breakout, or a 50% pullback of the entire rally. Again, if you use a tighter stop, you're going to lose more often, but you'll lose less. A wider stop, you lose a lot when you do lose, but you lose less often. It doesn't matter which stop you use. If they're both reasonable and you take 100 trades, you're going to make as much money using the tighter stops as you do using the wider stops. Can you buy here and risk 2 ticks? Can you buy here and risk 100 points far below the bottom of the screen? No, because neither one of those is reasonable. They're both unreasonable. If you use an unreasonable stop, it's a losing strategy. You will lose money. Some traders prefer high probability and they'll use the wider stop. Other traders are very concerned about risk and they'll use the tighter stop. As long as the stop is reasonable, it's a good strategy. I said there are lots of reasons to buy, and you can buy for any reason: at the market, above bar, below bar, above a new high. It doesn't matter. It doesn't matter which of these entries you take. The stop is the same. It's all the same trade. You're buying a bull breakout, and the stop for all of them is the same. Once you start to reverse up strongly, you can use a tighter stop. But at least initially, for any of these entries, the stop is down here, or one of these stops. But for me, I would use the wider stop. The location of your stop never depends on where you enter. The entry price has nothing to do with the stop. The stop has to do with what took place to the left, not the time that you enter. Once there's a strong breakout, maybe 2 or 3 bull bars, 3 or 4 bull bars, you raise your stop to below the bottom of the most recent strong leg up. This becomes a major higher low. Major because as long as the market stays above this higher low, the bull trend is intact. If it falls below a major higher low like this, then it's no longer a bull trend. It's then either a trading range or a bear trend. If you're buying on the premise that it's a bull trend and it falls below this low, your premise is no longer valid, and therefore you do not want to be long. You want to get out and then reassess. After every strong breakout, you raise your stop. That's called trailing your stop to below the bottom of the most recent strong bull breakout. We've got another breakout. It's less strong, but I would still raise my stop, usually to the bottom of the entire rally. However, if the trend is strong, it should not fall below the bottom of this little breakout. So this is a reasonable stop as well. This is a lot of trading range price action, and the market might be evolving into a trading range. Is this a major higher low? I don't think so. I think this is probably more the major higher low. In general, it's better to put your stop below the most recent major higher low if you are trading it like a bull trend. If you're buying here looking for a scalp, then you're not really trading it like a bull trend. Therefore, you might use a tighter stop. However, if the market is up here and it falls below a major higher low, if it's up here and it falls below a major higher low, if it's up here and it falls below a major higher low, then your premise of a strong bull trend is no longer valid. The market is now something else, like a trading range or a bear trend. If you're holding long because you believe it's a bull trend, and now you have evidence that it's no longer a bull trend, you have to get out, and therefore it makes sense to get stopped out below a major higher low. A very strong bull trend is a buy the close bull trend. It's the kind of trend where as soon as a bar closes, traders are looking to buy. When you see a strong bull trend like this, the easiest way to buy is as soon as the bar closes, you just hit buy the market. Or sometimes you can place a limit order if you're fast enough. As soon as that bar closes, you place a limit order to buy at that close, hoping to get maybe a tick better price. In general, it's simply better just to buy the market. Close of a strong bull bar, buy the close, buy the close, buy the close, buy the close. And that is a buy the close bull trend, as is this. Let's say you bought the very worst close. Let's say you bought here instead of here or here. Your stop is still down here. Your risk is small in that, yes, the actual point value is big, but the probability of getting hit is small. So your actual risk is probably going to be small. Buying closes all the way up. As soon as the bar closes, you hit buy the close. As soon as the bar closes, you hit buy the close. Usually get filled on the open of the next bar. Some traders will buy the close once and then just hold. Other traders will buy the close and then they get another buy signal. They'll buy more, they'll buy more, they'll buy more, they'll buy more. You obviously can only do that if the position size does not create too much risk for your account. Some traders will buy the close and then scalp out, and then they'll look for another strong close and buy again. As long as you're getting a series of consecutive good-sized bull bodies with the bars closing on their highs, it's a buy the close market. Usually you need 3 or 4 bull bars before you decide that it's a buy the close bull trend. One of my goals in life, although I've never done it, is once I see a buy the close bull trend, just keep buying every close until it's no longer a buy the close bull trend. I don't know if I'll ever do that. Usually I have a big enough position early on so that I don't want to be increasing my position. But at least that's one of my fantasies in life, that someday I'll just buy a close, buy a close, buy a close, and end up buying 10 closes in a buy the close bull trend. or sell 10 closes in a sell the close bear trend. I'll probably never do it because it would generate more risk than what I like ever having. When a buy the close bull trend forms in the final hour, traders have to be very quick to exit, and I talk about this in the video on trading at the end of the day. When the market's in a buy the close bull trend, there's a lot of profit potential. Some traders just get scared and they don't want to buy closes because they see the stop is far away and they just wait for a pullback. But by the time you get a pullback, it'll begin to look like the market might be reversing. 3 highs, reverse down, reverse down, reverse down. Maybe this is a parabolic wedge. And so they end up not making any profit because they did not buy the closes when it made sense to buy closes. When they finally get their pullback, they don't buy because they think the market might be reversing. It's better just to trade small, buy the close, and use the appropriate stop. It's like when you're a kid and you're jumping off the high board, you're terrified, you pinch your nose, you tighten up every muscle in your body, and you're in a tight ball, and you just jump. And then after a second or two, you're safe. That's true with these buy the close bull trends. You buy the close, you pinch your nose, and you're tense for a minute or so, and then all of a sudden, you're safe. The market is always in a cycle. It's in a strong breakout, it's in a channel, or it's in a trading range. As soon as you see the market in a breakout phase, that is a great time to enter because the math is very good for traders trading in the direction of the trend. High probability, even though the risk is greater, the probability of making money is very high if you manage your trade correctly. Again, you buy for any reason. You buy at the market, you buy below bars, you buy above bars, you buy bear closes, it doesn't matter. And then just use the appropriate stop. Once you get a strong enough breakout, you tighten your stop to below the most recent bottom of a bull breakout. Beginners always want perfect trades. They don't want to risk any money unless they're absolutely sure they're going to make money. That cannot happen. You should assume that you're never going to be more than 60% certain, and you cannot be paralyzed by the 40% chance that you're going to lose money. 60% is as good as it gets. Realistically, is the probability 60% that we're going up for a measured move after you see this? Yeah, it's actually probably 70%, but it's clearly much better than 50%. And that's as good as it gets. So you know what the risk is. And if your account size is big enough to risk that, you got to buy for any reason. If you're waiting for a pullback and it's not coming, and you're thinking that, oh, maybe I'm taking too long to enter, just buy at the market. Buy at the market. It doesn't matter if you're buying higher than you want. Just buy at the market, use the appropriate stop. Once you start getting pullbacks, a pullback is a bar going below the low of the prior bar, look to buy on a resumption of the bull trend. Buying above the high of the prior bar, that's a high one buy. If the pullback bear trend resumes down and you get another bar going above the high of the prior bar, that is a high two buy. So a high one bull flag or a high two bull flag, very good ways to enter in a strong bull trend. Sometimes you get a high three, so high one, high two, high three. You can call it a triangle, it's sloped down a little bit. You can call it a wedge bull flag. That doesn't matter, it's still a very good buy. The bears have not done enough to take control, and therefore the probability is we're going higher. There's a high one buy, high two buy. You don't have to take both, you just choose one and then rely on your stop, either here or here. High one, high two, high three, doesn't matter which one you take, your stop is below the bottom of the most recent strong bull breakout, down here. Sometimes the trend is very strong and you get a high one and it goes right up, and then a high one and it goes straight up. As trends mature, as they go on, as they add more bars, the pullbacks tend to be more complex. So instead of high ones, you start to get high twos or high threes. We're trying to reverse. Do you think that's a major reversal? Do you think we'll get a bear trend out of that? No, it's a minor reversal, and therefore it's more likely to create a bull flag or a small trading range, and the bull trend is likely to resume. Therefore, you bet that reversals will fail. Here, we're trying to reverse a failed breakout of this high. We're trying to reverse a second time. Now we have a bear breakout, a close below the low of the past 3 bars. These are reversal attempts. They're going to fail. Instead of selling, you buy. Here, we have a failed breakout. We have a wedge, 1, 2, 3, wedge top. You look to buy reversals down. Here's a second entry short, first entry below that bull bar, and now second entry here, a micro double top. It's probably going to fail. So you buy below the low of that bar. Here, we got a 2-bar reversal up and down, a failed high 2 buy, high 1, high 2, maybe high 3, and it's failing. Well, guess what? The first strong bear bar is probably going to fail to reverse the market. Bulls will buy that close. Again, we have a small double top, but a doji bar. You're going to buy the low of that bar, or you're going to buy that small bear bar, betting that it's not going to be enough to reverse the market. So you buy the close of bear bars. You buy below bars. You buy below the bar, betting that the attempt to reverse down will fail. You buy a breakout to a new low. This bear bar closed below the low of the past 6 or 7 bars. Is it going to be a successful reversal? No. The odds of it being successful are small, and therefore it's going to fail, and the bull trend will resume. These are all reasonable entries, and it doesn't matter which of these entries you take, your stop is here. It doesn't matter which of these entries you take, the stop is here. You know where the stop is, and if you can risk enough, then you just take the trade. Strong leg up, traders will buy a 50% pullback. We did not get there here. However, a lot of traders will place a limit order to buy a 50% pullback. Some traders will simply buy 1 point below a low. This low is 1 point below that low. So instead of buying at the low of that bar, they'll place a limit order to buy 1 point below. Or if the pullbacks are getting deeper, they'll buy 2 points, 3 points, or 4 points below. They'll buy 1, 2, or 3 points below the low of the prior bar, or they'll buy 1, 2, or 3 points below the low of the high close. We have a buy the close market. The bulls who bought that high close will look to buy more lower. They might place a limit order to buy 1 point down, 2 points down, 3 points down, betting that whatever reversal we get will not be enough to reverse the trend, and that we'll get back to that close. Again, it doesn't matter how you buy. It doesn't matter what your reason is. When the trend is very strong like this, the math is actually okay to scalp, but the math is really good for swing traders. Therefore, you should try to swing at least part of your position, always using the correct stop. By any of these reasons, stop either here or down here, and you just hold until either there's a reasonable sell signal or until the end of the day. Beginners always want perfect trades. A perfect trade is a trade where you have a high probability and you're going for a great risk reward. In other words, very little risk and very big reward. Now, that can never exist, because if it's perfectly good for you, it's perfectly bad for the institution taking the opposite side. If you have a high probability of a very big profit with very little risk, no one's going to take the other side of the trade. It will not take long for the institutions to recognize the setup, and then everyone will want to do exactly what you're doing, and there won't be anybody left to take the other side of the trade. And therefore, a trade that gets anywhere near perfection cannot exist because everyone would start to trade it. And all of a sudden, there will not be enough people to take the other side. If it's perfectly good for you, it's perfectly bad for an institution doing the opposite. In other words, they would have only a very small probability of making only a very small profit, yet their risk would be very big. Nobody would take that trade. There are three variables in the trader's equation: risk, reward, and probability. And you can combine risk, reward into a single variable. Every trade is a trade-off between probability and risk, reward. A lot of trades have decent probability and decent risk, reward. Some trades have high probability. Those trades always have bad risk, reward. Other trades have great risk, reward, and therefore they always have low probability. If you have high probability of winning, the other side has better risk, reward. If you have great risk, reward, then your probability of success is small. Let's say you buy the reversal up from yesterday's low. It's the second entry buy. The first was above here, the second is here. You stop at small. At that point, you do not see all of these bars. You have a very small risk. You have potentially a very big reward. So you have fantastic risk reward. What does that tell you about the probability at that point of making a lot of money? It tells you that you're probably not going to make money, that your stop will probably get hit. But sometimes it'll work. And those few times when you get a huge trend like this, it more than offsets all of the losses. Even if you lost 70 or 80% of the time taking this buy, the 20% of the time that you win has so much profit that it more than offsets all of the losses. Is this only a 20% chance of winning? No, it's actually probably about a 40% chance. You have a failed breakout below yesterday's low, trying to reverse up here, and now you have a second entry for the failed breakout above yesterday's low. You have dojis, that tends to lower the probability, but the risk is small, the reward is good. You have about a 40% chance of a swing up. By a swing up, the minimum goal is at least twice your actual risk. That means your minimum goal for this to be a profitable strategy is a move to right around here. However, exiting at the minimum goal is rarely the best option. And if you see the market start to turn up reasonably strongly, it's better not to exit and hold at least part of your position, because you might be buying early on in a very strong bull trend. This bull had a 40% chance of a swing up. What about this bull? They have the same stop, whether you bought here with a stop here or you buy here with a stop here. This bull, the risk is far greater. His risk-reward ratio is much worse. This bull had a great risk-reward ratio, but low probability. This bull has a terrible risk-reward ratio, but outstanding probability. Both are reasonable trades. The trader who buys here is a trader who prefers high probability trades. The trader who buys here is one who has risk-reward as his priority. Again, you should never worry about perfection because it cannot exist. As long as you can structure a trade that has a positive trader's equation, the trade is good and you should consider taking it. I began by talking about bull breakouts, and then I moved on to talk about very strong bull breakouts, by the close bull trends. The important message is, once you think that a bull trend is strong, you have to buy, even if you're simply buying at the market. You know where the stop has to be. Trade small enough so that you can use the correct stop, but you have to get long. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading breakouts. I want to emphasize the importance of using swing stops. At some point, a breakout has pullbacks and it then enters a channel. Once it enters the channel, you trade it differently. A breakout often follows a trap, a move that you think is good, and then the market reverses and goes the opposite way. Sometimes there's an advantage to entering on a smaller time frame. You can reduce your risk. Most traders should stick with a single time frame. Very strong bull breakout. We have two small pushes down, leg one. Bull tried to resume, that's the high one buy, and then a second leg down, and now a decent bull inside bar for a buy signal bar, a test of the breakout point. It's a good high two bull flag and it's a reasonable place to buy. You have a decent buy setup, a strong buy signal bar. It's reasonable to put your stop just below the low of the pullback. However, if you want a higher probability, you have to use a wider stop, like maybe below the bottom of the breakout or below the bottom of the entire bull trend. If you think about it, this could easily have a third push down, 1 pullback, 2 pullback, 3, and become a wedge bull flag. And therefore, the probability using this stop is not necessarily as high as it could be. A better stop is here or here. Because you're buying a high two bull flag, the first pullback in a strong bull trend, and you have a good buy signal bar, the probability is high that you're going to make money. And when that's the case, you can take profits at 1 times your actual risk. Whenever the probability of making money is 60% or higher, the trader's equation is positive if you simply take profits at 1 times your actual risk. Here, if you bought above the high of this bar, you got filled here. Your actual risk is to just below the low of your entry bar, and it's only 2 ticks. Theoretically, since the probability of making money is high, you could exit with only 2 ticks profit, and you would have a positive trader's equation. If you took that trade 100 times and you managed it properly, placed your orders correctly, you would end up with a profit, a high probability of making a profit. High probability, it's always mathematically acceptable to take profits at 1 times your actual risk. As I discuss in other videos, the minimum scalp in the E-mini is 4 ticks. You should never be going for a profit of less than 4 ticks, which is 2 times your actual risk. The problem with taking a profit that's too small is you have to be perfect, and you have to be perfect all the time, because small mistakes, even infrequent mistakes, can erase many profitable trades when the profit is small. I want to say one other thing about going for something that's mathematically acceptable. Just because it meets the minimum requirements for a positive trader's equation does not mean that it's the best thing to do. There are very few things in life where choosing to go for the minimum is the right choice. There's almost always a better choice. And when you have a strong bull trend like this, the breakout is 10 points or more tall, going for a 1-point scalp is probably a bad choice. You're probably going to get a rally that's equal to a measured move, maybe based upon the height of the bodies here, or maybe based upon the height of the bull leg. Probably means 60%. So 60% chance the market's going up here. Does it make sense to take a 1-point profit and exit right here? Of course not. The open of the first bar of the breakout, the close of the second bar of the breakout, 60% chance the market is going to reach there before it gets here. And therefore, exiting with 1 point is a bad decision. You have a 60% chance of making many times more points. If you have a limit order to take partial or full profits at this measured move target, and it does not go above the target, and you do not get filled, you can always take profits on the reversal down below the low of that bar or below the low of a bear bar here. Or a second reversal down. First reversal down here, bull trend resumes, and then we have another bear bar here. That's another logical place to take profits. However, when the trend is this strong, chances are it's going to go higher still. Let's say you bought here and you exited here on the first reversal down. You'd say, oh, that's 5 points profit, and a scalp is 1 or 2 points, a swing is 4 or more points. In this particular case, I would call that a scalp, even though it's 5 points. The day's range is fairly big. You're exiting right after a very strong breakout. The odds are high we're going to get a second leg up. You're exiting before there's even a single pullback. I don't care if you call it a scalp or a swing. In my mind, if you're exiting after a very strong breakout on the first minor pullback, that's scalping type of trading. Let's say you happen to buy the close up here. You may have bought here and taken profits. You may have bought here and maybe you're buying more. But let's say you buy this close for any reason. Your stop should always be below the bottom of the most recent strong bull leg. We have a strong breakout to a new high. This is a major higher low. As long as the market does not pull back below that low, the premise of a bull trend is still valid. And therefore, if you're buying this, believing you're in a bull trend, your stop goes here. You're only wrong if it gets below this low. If it is in a bull trend, it will not get below that low. There might be a deep pullback, but if there is, chances are the market will bounce back to this level before it gets below that low. If you have that deep pullback, instead of a bull trend, you'll have a trading range. If you do get the deep pullback, a lot of traders will buy more on the resumption back up. Let's say you buy that close and you're confident that the pullbacks will be small after such a strong breakout here and here. You're not going to be able to buy much lower. Some bulls would buy maybe a couple points below that close, betting at a minimum that it will get back to that close. Some bulls, the bull scalpers, would exit. They buy here, they buy more 2 points lower. It has to get above this close to get out break even on their first entry, and with 2 points profit on their second entry. And that's what happened right here. And you can see the selling at that high close. The market's clearly still always in long, even after this bear bar. And therefore, swing traders would not exit. They would continue to hold long. A pullback is a pause in a bull trend. It usually means that the high of the bar is below the high of the prior bar, or the low of the bar is below the low of the prior bar. But that's not always the case. For example, this is a pullback in the bull trend as well. The market went up and it went down, so a doji bar. And here we have an inside bar. That's also a pause in this bull trend. A bear body, even if the market is still going up, is another pause in a bull trend. Those are all pullbacks on lower time frames. I mentioned a moment ago that if a market starts to behave like it's in a channel, you have to trade it like a channel. And that is somewhat different from trading it when it's in a breakout. A trend is made up of a couple parts. There's a strong breakout. Here we have a second strong breakout. And then you get a pullback, and then the market starts to channel up in a weaker bull trend. Ultimately, it transitions into a trading range. Breakout, a very strong bull trend. Here we have a second strong breakout. And then a channel follows a pullback, and it's still a bull trend. This channel is very tight. On a higher time frame chart, it would be a breakout as well. It would look like this maybe on a 15-minute chart. As soon as there's a pullback, the channel phase has begun. Here, instead of a channel, we got another breakout. We have a pullback here, and now we have a channel. We no longer have consecutive big bull trend bars. We have pullbacks every few bars. We have bear bodies. We have bars with tails on top. That is a weaker bull trend. It's still a pretty strong bull trend, but it's certainly less strong than this or this, where you have a series of bull bars closing on their highs and very little overlap between the bars, and the tails on tops of the bars are small. It's important to watch the breakout phase. You want to see when you think it has ended and has entered a channel. Because once it has entered a channel, you trade it a little bit differently. Again, instead of consecutive big bull trend bars closing on their highs with very little overlap like this, we're getting smaller bars, smaller bodies. The tails on top are becoming more prominent, and we're also getting several bear bars. Pullbacks are coming every few bars instead of no pullbacks at all right here. You can see the videos on trading tight channels and trading broad channels to get more information about channels. This video is about trading breakouts. Another thing that you'll notice in channels is bulls start to take profits at prior highs. They start to sell at prior highs. They buy pullbacks instead of at prior highs. Here, they're buying all the way up, including at the highs. Here, bulls are starting to take profits at every new high, so you're getting a pullback. In addition, the bears are starting to sell prior highs, scaling in higher, betting that the market will pull back enough for them to make a profitable scalp. That's an important sign that a channel is transitioning into a trading range. We do have a bull channel, and it did transition into a trading range for about 30 bars. There was ultimately bull trend resumption, but it was in a pretty tight range for about 30 bars. Bears who sold at this high, or sold above this bar, or sold above this bar, were able to scalp out with a 1 or 2 point profit down here. Therefore, limit order bears selling above bars, are beginning to make money, and that usually leads to a trading range, which we have over here for about 30 bars. When the bears first sell, they use wide stops, maybe a measured move up based upon this rally way up here. They're never planning to let that stop be hit, but that's their initial catastrophic stop. They sell, and they sell more higher. They sell at this high and maybe sell 1 or 2 points higher, or instead of selling at this high, they start selling 1 or 2 points higher, looking for a 1 or 2 point scalp. They're looking for quick profits. As the bull trend weakens, as it matures, it becomes weaker and transitions more into a trading range. It's important to notice if bears entering with stops can now make money. For example, here, maybe a little final flag, a bear bar closing on its low. Some bears might short that on a stop below that low. And if they're scalping, they only need 1 point. This did fall far enough for them to make a 1 point scalp. And that is further evidence that the bull trend is weakening. Initially, the bears can only make a profit by selling with limit orders above bars. If they start making money with stops selling below bars, that requires the market to fall even further. That is a sign that the bull trend is weakening even further. Even though we ended up with a channel all day, spike, pullback channel, this is probably soon going to transition into a bigger trading range. We don't know that. We don't see what tomorrow looks like, but we're starting to get trading range price action. And you have to assume the market will become increasingly two-sided as this trend progresses. When the market's rallying like this, it's buy the close. Traders are buying strong bull closes, or they're simply buying at the market. However, when you're starting to get a lot of trading range price action, bulls are no longer willing to buy at the close of bars. Instead, they look to buy pullbacks. They can buy on a reversal up, a resumption of the bull trend, like above this bull bar. You can call this a bull flag, a bear channel, bull flag, a wedge, bull flag, 3 pushes down, 1 or 1, and then 2, and then 3. decent looking buy signal bar. They'll also buy with limit orders below bars, like below this low or below this bar, betting that the bear reversal attempts will fail. In any case, instead of buying at new highs and at the market as the market's going up, they're beginning to buy more at pullbacks. And they're starting to take profits when the market gets up near the prior high. Further evidence that the channel is weakening and beginning to have more trading range price action. It's becoming difficult for the bulls to make money and difficult for them to make much money. For example, if they bought above this bar and got filled here, somewhere in here, they're getting bad follow-through, dojis at the new high, and therefore the bulls will take quicker profits, like a 1-point profit or a 2-point profit. They're less willing to swing, and they're scalping a bigger part of their position. Breakouts sometimes follow a trap. So sometimes the market starts to do something and then quickly reverses and does the opposite of what you think it will do. Some traders get trapped into doing the wrong thing. We have a bear trend. We're starting to get some good buying pressure, good bull bars, maybe a wedge, 1, 2, 3, and we have a double top bear flag. The market rallied for about 8 or 10 bars, maybe a strong enough minor reversal so that the next reversal up will be major. The context is getting good for a reversal up. We're also at the bottom of the bull trend, so a possible big double bottom. Wedge bottom, above the bottom of this strong rally. Big tails on the bottoms of bars, 2-bar reversals, so down and then up, down and then up. We're getting buying as the market's trying to go down. The bears have a double top bear flag here, a low 2, low 1, low 2, and it's reversing up, so it looks like it's failing. Is this a high or low major trend reversal? Well, when I look at that, I probably would call it minor. We went up for about 8 bars or so, but the leg down was only 3 bars. Normally, you need more trend resumption down before you'll get a trend reversal up. We have a double bottom higher low here. Some bulls will buy this and take a chance that it will turn into a major reversal, maybe test the top of this wedge. We don't know yet if this is a big minor reversal or a small major reversal. It's a reasonable buy. The reward, maybe testing up here, is more than twice the risk. The probability might be 40%. Now, what do? We have a strong bear bar, a low 2 short, low 1, low 2. We have a double top here, so a bigger low 1, low 2. This is a good setup for the bears. They have a double top bear flag, this high and that high. The first high is actually a double top itself. And they have a good looking sell signal bar, and it's a low 2 here, low 1, low 2, and a double top, so it's a bigger low 1, low 2. Maybe it'll fall below the neckline of the double top, 2 tops neckline down here for a measured move. Strong sell setup, not a particularly strong buy setup. Bulls will exit below that bear bar. The market's still always in short. The bulls have not yet done enough to convince traders that they have taken control, and therefore the bears are still in control. These bulls who bought here have a low 2 and a bear trend with a strong sell signal bar. They should get out below that bear bar. Trading range may be about 15 bars here. If you want, you can call this whole thing a trading range. Every bar that gets added to it reduces the probability for the bears, reduces the probability of trend resumption down, bear trend, trading range, trend resumption down, and it increases the probability of trend reversal up. It's still better than 50-50 for the bears. The bulls have not yet done enough, but the probability is getting close. What's the force behind this strong sell signal bar? Well, if you think about it, it's good for the bulls to create a strong sell signal bar and prevent the sell from triggering. And why is that? Because if the bulls create a strong sell signal bar by selling, right? Their computers can sell and make sure this bar closes on its low. They're creating a strong sell signal bar. Everyone knows that most bulls who bought here will get out below that low. If they can create a strong sell signal bar and prevent the sell from triggering, that would be a sign of strong bulls. It's to their advantage to demonstrate strength, and one way to demonstrate strength would be to prevent a strong sell setup from ever triggering, preventing the market from falling below that strong bear bar. So what happens here? We have a strong sell setup with a good sell signal bar. Everybody knows the bulls will get out below that bar and the bears will sell below that bar. But what happens if it does not go below that bar? That is a sign that the bears are not strong. They have a great sell setup and they could not trigger it. The bulls would get out below that bar, yet the bulls were able to prevent the market from falling below the low of that bar. And therefore, the bulls did something to prove that they're strong. The market got down to the low of that bar on the next bar, but not below. The bulls prevented the bears from triggering a sell that would have flushed all the bulls out. Instead, the market went up, and the bears who front ran the signal, the bears who sold, for example, at the close of this bear bar, got trapped into selling what turned out to be a bear trap. The bulls who did not yet buy, they'll buy above the high of this strong bear bar, seeing that the bears are going to panic out. They were selling, trying to create a strong bear flag, a double top bear flag, expecting traders to sell more to trigger the sell by going below that bear bar, and instead it went above the high of the bear bar, and the bears are giving up. Because the bears are giving up, it's reasonable for the bulls to buy as well. So if the bulls did not buy here, or if they did not buy on that bear close, a lot of bulls will start buying above bars, like above the bear bar or above this pullback bar. The bears had a double top bear flag. They were expecting a measured move down, maybe based upon the height of the trading range, maybe from the double top to the neckline down. If you get a bull breakout above a double top, instead of getting a measured move down, you have to be thinking about a possible measured move up. And when the market gets there, it's very common for the bulls to take some profits, and that creates a pullback. It's also a test of the top of this wedge bottom, and that's another location where bulls will take profits, and aggressive bears will start selling, at least for a scalp. Let's take a look up here. We're in a bull trend, and we have a pullback. Is it a bear trend at this point? No, it's about a 50% pullback from this bull breakout, and the bulls are trying to get a high one, a high two, a bear breakout, maybe a small second leg down here, so another high one, high two. It's still a bull flag. It's reasonable to take the buy here for the failed bear breakout, or take the buy here, a high two buy, second entry buy. What else is going on here? Well, it's more or less an endless pullback. The channel down is fairly tight. It could go on a lot further. And it's a third push up, 1, 2, 3. I have it drawn connecting the highs of the first and third push. Does not matter that the second push is above. And it's also a bull breakout of a triangle. We have a triangle here, 3 pushes down, 1, 2, 3. Bull breakouts of triangles. Triangles are often final flags, and therefore you have to be thinking that this bull breakout might be the final leg up, and we may pull back into this triangle. Also, the channel down is fairly tight. The pullback back up is only 1 bar. It's therefore possible that this is an endless pullback from a bull breakout. An endless pullback after it goes about 10 bars. If you start to see a bear breakout, the bulls are giving up, the bears are selling, and you're probably going to get a measured move down. We have a bear breakout bar below a high 2 bull flag, and we have a bear follow-through bar. A lot of bears will sell the close of that follow-through bar, and you can see what happened. By the bears creating this breakout, they're trapping bulls into a loss. The bulls who bought up here are giving up. This series of bear bars is a give-up collection of bars. The bears are making the bulls give up. The bulls are now trapped into a losing trade. They need to get out to reduce their losses, and they're selling here. Some bears will take this early sell on the follow-through bar. Other bears will wait until we have a very clear and strong bear breakout and then sell. Higher probability of making money if you sell after a strong bear breakout. However, your stop is further away, and that's always the trade-off. If you want the higher probability entry, once the market's clearly going to have at least a small second leg, your stop is always going to be further away, and you have less profit remaining in the trade. Therefore, greater risk, smaller profit, worse risk reward. That's always going to be the case whenever you take the higher probability trade. We have a bull trend, fairly tight bull channel, and we have a pullback here. A bull inside bar. This low is a little bit below that low, so it's not really an inside bar, but it's a bull bar pulling back. Its high is below the high of the prior bar. It's a reasonable buy above the high of that bar. So let's say you took that buy. Where's your stop? Is it below the low of that bar? No, you cannot do that. We have dojis here. We might get 2 legs down, may get a 3rd leg down to a wedge bull flag. Still bullish, still likely that we're going higher. So if you take that buy, your stop is down here. Had you taken that buy and you bought above the high of this bar, you would have been filled here at the top of this bear bar. The market went to a new low and then resumed up. Once the market started going up, you could calculate what your actual risk was. You actually had to risk from your entry price to 1 tick below the bottom of the pullback bar. So that's your actual risk. High probability trade, since you're buying in a strong bull trend, therefore mathematically okay to take profits at 1 times your actual risk. The initial risk was down here. This is where the stop was. If you buy up here, it pulled back a little bit more and resumed up. Once it started to go up, you knew that you actually only had to risk to below this bar. Although you did not know it at the time, if you put your stop at that line, which turned out to be 1 tick below that bar, you would not have been stopped out. So that means you actually risked from your entry price to this line, 1 tick below that pullback bar. The high 1 evolved into a high 2 in a strong bull trend, and you have another good-looking bull bar. It's a high probability bet that you're going to make money taking either one of those buys using the appropriate stop. Because you're taking a high probability buy, you can take profits that are just 1 times your actual risk. That's all you need for a positive trades equation. If your actual risk is less than a point, never take profits at less than a point. So you have to take profits at least 1 point. And if the market is moving up with fairly big bars, even 1 point is usually not enough. Here, the actual risk is more than a point, and the trend is weakening. We're getting dojis and we're going sideways. High probability of a profit, reasonable to take profits at 1 times actual risk. You could also try to get out with 1 times initial risk, which would be your entry price here, measured move up from your initial stop to your entry price and way up here. Some traders would hold for that, especially since they see a strong breakout here. They expect a small second leg up. That would be reasonable as well. Obviously, you're going to exit over here because the day is ending. That would be getting out around 1 times your actual risk. Reasonable to take profits 1 times actual risk. You buy above this bar, get filled here. The market starts to go up after pulling back. You know your actual risk is here. High probability of making money. Reasonable to exit at 1 times actual risk, especially since you're making It looks like maybe 3, 4, 5 points. Let's say you typically like using a 2 or 3 point stop in the E-mini. Here, if you're buying above this bull inside bar, your stop is down here, and that is 7 points below. You can only take that trade if you can reduce your position size. If your account is so small that you can only trade one contract, you cannot reduce your position size. And since the appropriate stop requires a smaller position, given how much you typically risk, you simply cannot take the trade. Just wait for another trade. We're in a trading range. The bears got a breakout and a strong reversal up. Big tail, not good for the bulls, but close above the trading range high. And this small bull body, even though it's very tiny, is enough follow-through buying to make it likely we'll go at least a little higher. Reasonable to buy the close of the breakout bar after the reversal up from the bear breakout, or the close of the follow-through bar, or on a stop above the high of this inside bar. It does not matter which of the buys you take, the stop is below the bottom of the bull reversal. All right, without looking at the price scale, you say, wow, that's a pretty good reversal, pretty good rally. We're probably going higher. And you are right. However, if you normally risk 2 or 3 points on a trade, you cannot take this trade, because if you buy here, these two bars are 70 points tall. You'd have to risk 73 points on this trade. If you normally risk 2 points or 3 points, you simply cannot take this trade. You just watch it and say, oh, this is interesting. It's a learning opportunity, but you're not going to be able to take the trade. Consecutive huge bull trend bars, although you don't see it, the market gapped down and hit the monthly 20-month exponential moving average and then reversed up strongly from that average. And the reversal from this low to that close is 73 points, and it occurred in simply 10 minutes. The average daily range prior to today was only 20 points. And today, the first 10 minutes, we have 73 points. Reasonable to buy the close, but only if you're comfortable risking that much money. If your account is so small that you don't typically trade multiple contracts, then you cannot reduce your position size, and therefore you cannot take this trade. Your risk is maybe 20 times bigger than your typical risk, and unless you can trade 1/20th as big as you normally trade, you should not take this trade. What does an expert do? Well, I'm buying this close, but I'll use the correct stop and I'll trade the correct position size. You have other choices as well. You could trade ETFs that mirror this, or you could trade a very small size, or you could trade low price stocks that mirror this, or you could simply buy calls, like weekly call options. This is a day chart of the SPY, the spider. Very strong bull trend. It's a breakout on a higher time frame chart. The market rallied about 20 points, which was about 10% over the course of about a month or so, a month or two. Let's say you did not get long here, and let's say you're thinking about getting long here, and let's say you do not want to wait for a pullback. Where's your correct stop? All the way down here, about 20 points down, which is about 10% down. Some traders will say, gosh, I don't want to risk 10% on one trade. And therefore, they have to look for stock replacement. Also, some traders who are long, let's say they're long the spider, will say, gosh, I don't want to risk 10% on my trade. I'm going to sell out of my spider and then replace my stock with something else. buying up here, stop is down here. It's about 10% of the entire contract. Contract is 200, so your stop is about 20 points. That's about 10% below your entry price. A good choice if your account is big enough to allow you to trade options is to buy a call option or a call spread. I will talk about that more in the options trading course. A trick that some traders use is they enter on a lower time frame chart. They look at one time frame to see what patterns are unfolding, and then once they see one that looks good, they'll look at a smaller time frame chart to place their orders to enter. Here's a 5-minute chart of the E-mini. The market rallied about 35 points here. Strong bull breakout, rallying about 15 points in a matter of a half hour or so. You have to get long, and you could buy for any reason. You could buy closes. Let's say you buy that close. Some traders, when they see a strong breakout like this, they have to get long. Everybody has to get long. And you have different choices. You can buy at the market, buy closes, or you can wait for a pullback, but the market may go very far before there actually is a pullback. If the market is rallying very quickly and you're afraid of missing out and you don't want to wait for the close of the bar and you don't want your stop too far below, an alternative is to look at a smaller time frame chart and look for pullbacks there. For example, this is the 1-minute chart. This green box is exactly this green box. Had you bought this close, this is where you would have entered, right there. The market keeps trying to reverse. A very tight bull channel. You have to assume all the reversals will fail and that you won't even see these pullbacks on the 5-minute chart. You do not. On the 5-minute chart, there are no pullbacks. Let's say you buy the close of this bar on the 5-minute chart. But as the market was going up, you thought it was going to go higher and you were eager to get long. Some traders will look at a 1-minute chart. These first 3 bars are right here. On the 5-minute chart, if you're buying a pullback, you're buying up here, right there. This would be the same fill. If you had placed the order to buy below the low of that bar and you got filled here, on the 1-minute chart, this is where you would have been filled. An alternative, when you're seeing this market rallying like this, is to put up a 1-minute chart, and as soon as you start to see 3 or 4 bull bars closing on their highs, you can buy the close. This is a buy the close rally on the 1-minute chart, and let's say you bought way at the top up here. This is the top of the blue box right here. It's really a pretty early entry on the 5-minute chart. And taking the 1-minute buy the close entry is buying 6.5 points lower than taking the 5-minute buy the close entry. Or once you've had 4 or 5 consecutive bull bars, you can look to buy at the low of the prior bar, betting that the first reversal down would fail. And here we finally have a bar going below the low of the prior bar. You place a limit order to buy the low of the prior bar, not filled, not filled, not filled. And you keep raising your order. And at this point, when you see this bar close, you place a limit order to buy at its low, you finally get filled right here. You could also, as I said, simply buy closes on the 1-minute chart. After you've seen the 3, 4, or 5 good bull bars closing on their highs, you simply buy at the market. And had you done that here, your entry on the 1-minute chart would have been 8.75 points less than the entry on the 5-minute chart, buying the close up there. Does not matter where you buy, your stop is at the bottom of the bull leg, just below the bottom. Strong breakout, you have to get long. And if you're unable to buy closes, or if you don't want to risk that much, you can look at a 1-minute chart for an earlier entry. either buying closes on the 1 minute chart or buying the first pullback. I began by talking about the importance of using swing stops. Even if you're scalping, it's usually better to use a wide stop. If you're buying in a breakout and the market starts to get pullbacks and enters a channel, you change how you trade. You begin to trade it like a channel. Breakouts often follow traps. The market is always trying to trap traders into doing something wrong, and very often the market will have a setup to go one way, and then it will quickly reverse and break out in the other direction. So you have to be aware when traps are forming and you get an opposite breakout. Some traders like to find setups on one chart and then look to enter on a smaller time frame chart. And that is a reasonable thing to do. Most traders, however, should just trade one chart and not be switching time frames. Too easy to make mistakes. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading breakouts. Whenever a breakout is weak or the follow-through is bad, it's probably going to evolve into a trading range. I'm also going to talk about bear breakouts. We have an attempt at a wedge bear flag. We reverse down, reverse down, reverse down, but instead we got a bull breakout and decent bull follow-through. At this point, you know a couple things. One is the market wants to go up. However, you do not know if it's going to continue up, maybe a small pullback can continue up, or if it'll have a very deep pullback. If it has a very deep pullback, instead of a breakout into a bull trend, it's probably going to be a breakout that leads to a trading range. Less likely, you'll get a failed breakout and a reversal down. Usually you need more than just this micro double top. You have a high one bull flag, we went up, we went down, we went up, maybe we go down. This is a strong enough breakout so that the odds are the first reversal down will be bought, even if it's a deep reversal. If it's a deep reversal, you're probably going to see a trading range. If it's a small reversal, you'll probably see some kind of a measured move up based upon the height of the breakout, or maybe based upon the height of the trading range. You're already up to about a measured move based on the height of the trading range. We have a trading range lasting about 15 or 20 bars. A lot of prominent tails below bars. And then we have a small reversal up. We have a wedge, so it's a small spike in channel, spike, pullback, second push, pullback, and then third push. Instead of testing down to the bottom of the channel and forming a trading range, we're getting a bull breakout. At this point, the height of this trading range, this wedge bear flag, is about half the size of a normal day's range, and therefore you're expecting a normal day's range. Hence, you expect the range to approximately double. You don't know if this is going to be the start of a bull trend day and result in a bull trend that's much bigger than an average day. However, with this tail on the top of the breakout bar, new high of the day, breakout, and then a big tail on top, it looks like a weak breakout. And also the bars in the breakout are not particularly big. Tail, small bar, tail. Whenever you see a breakout that's weak, you have to assume that the breakout's going to lead to a trend. However, it's probably going to be a weak trend, like a trending trading range day, where you have a trading range, you break out for 3, 4, or 5 bars, and then you form another trading range. Whenever you have a breakout that does not look as strong as you would like, it's probably going to be a bull leg in a trading range rather than the start of a big bull trend. It still could be a spike, pullback, and then we could channel it for the rest of the day. But the bars are not especially big compared to the bodies of the bars over here. And you have that tail, and you have the bad follow through here after a breakout bar, plus the breakout bar has a tail as well. This looks like a weak breakout, and that increases the chances that it will evolve into a trading range pretty soon. We just don't yet know if the trading range will be a channel up and then a range, or if it'll be immediate reversal down and then a range down here. And this is what we got. We had a deep pullback, more than half. We pulled back below this breakout point, but not below the top of the wedge. We had 3 consecutive bear bars, all closing below their midpoints, and 2 closing near their lows. This is enough of a big up, big down move to create big confusion, and confusion usually results in the market going sideways. At the close of this bar, most traders assumed that the pullback was too deep for the breakout to be leading to a strong bull trend. They instead assumed that, yes, we're probably always in long and we're probably going to stay long for 10, 20, or 30 bars. However, the pullback is deep enough so that the bulls are sufficiently disappointed that they'll be scalping near new highs instead of buying breakouts to new highs. And the bears see this deep pullback as well as a sign of weak bulls, strong bears, and when the market gets up near the high, the bears sell, betting that a trading range is more likely than a bull trend. Buy low, sell high, and scalp. You can see the videos on trading and trading ranges for stop placements and how to trade when the market does this. I said that after the weak breakout and then the deep pullback, traders expect a trading range, so they buy low, sell high, and scalp. Both the bulls and the bears are buying low. The bulls are buying, expecting a test up to the top of the range, where they'll scalp out, and the bears are buying low because they sold high and they're buying back their shorts. Both bulls and bears are selling high. Bears are selling high, betting that breakouts of bull flags or of the top of the range will fail, so they're selling, looking for a scalp down. And the bulls are selling high to take profits. They see the rally is weak, they doubt it's going much higher, and therefore they're selling out of longs. This is a strong enough breakout, 4 consecutive bull bars, several closing above their midpoints. It's strong enough so that the odds are will either go up, even if there's a pullback, or if there's a deep pullback, we'll get back to this price level. And therefore, bulls will buy closes. They'll buy this close, that close. Some bull will buy this close. And then once he sees this bear bar, he'll say, I don't know. That's pretty bad follow through. I have a decision to make. Do I think it's going to reverse down and become a bear trend? Not likely. 4 consecutive bull bars in the breakout. Probably the best the bears can get is a deep pullback and then a trading range. And therefore, some bulls, instead of getting out below that bear bar, will hold long, wait for a reversal down, and then buy more above the bull bar, betting that the market will get back up to their original close. It was reasonable to buy that close. If you do something reasonable and you manage your trade correctly by scaling in using an appropriate stop, you're usually able to avoid a loss, and almost always you can make at least a small profit. The bears, they see this as 2 legs up already. 1, pullback, and then 2, and they see this as a reversal, and they're thinking, it's probably going to get a pretty deep pullback because that breakout's not all that strong. And they see this as a terrible follow-through bar, so the bears will sell below that bear bar, and they'll get filled over here, betting that it'll fall far enough for at least a scalp. Bears take profits either at a fixed number of points down, 1, 2, or 3 points, or they'll take profits on the reversal up as long as they can make at least a minimum scalp. And meaning that would be about 1 point. If the reversal up began right here, instead of all the way down here, a lot of bears would hold short expecting a second leg down. However, if it pulled back to here and then started to bounce, and it pulled back again and started to bounce again, that would be a high 2 bull flag, and the pullback was not deep, most bears would then get out with a small loss. Remember, there were buy the close bulls, some of whom thought the chances of a bear trend were small, so they held long, stopped down here, here, or here, and then they looked for a bull bar to buy more. They want the second entry to be at least as big as a minimum scalp, 1 point in the E-mini. They would rather it be 2 or 3 points. They're expecting the market to get back to that close. They can get out, break even on their first entry when it gets back there, and then with the scalp profit on their second entry. The buy the close bulls who bought this close, this close, this close, they may have bought one, they may have bought all. Anyway, there will be some bulls who bought this close, and they're hoping to get out break even on that entry after they see this terrible follow through. Many of them bought more above this bull bar, and they get out with a profit on their second entry. And that is why you have that tail on the top of that bar. What took place was a lot of the bulls were sufficiently disappointed by the sell-off that they were just happy to get out break even if they bought that close. Also, the bears knew these bulls were very disappointed by this. They knew the bulls would be selling out there, and therefore the bears sold there, at least for a scalp. The market's always in long here, and probably still always in long here, despite the 3 bear bars. The 3 bear bars created a deep pullback, still above the bottom of the bull breakout. It's slightly more than a 50% pullback. Usually the bears need at least a micro double top, and this is not enough to turn it to always in short. If this continued down here, below the bull breakout, then traders would see it as always in short, and they would expect maybe a bear trend. That is not what happened. Most traders, even professional traders, do not like to reverse. I do sometimes, but I really don't like it. If I'm in a position and there's an opposite signal, I usually get out of my trade and not take the opposite signal. I usually wait at least 1 or 2 or 3 bars before looking for a trade in the opposite direction. I want to make sure that I am totally objective. And if I'm thinking that the market's going up and then it starts to go down, I usually wait 1, 2, or 3 bars before I make a decision about how strong the bears are. It's also hard emotionally to do 2 things at once, to exit long and to go short. However, if you're able to do it profitably and comfortably, then go ahead and do it. The bulls who bought anywhere during this bull breakout saw a disappointing bar here and then even more disappointing bars here. But it's still above the bottom of the bull breakout and still above the bottom of the bull trend. It's still always in long. And this sell-off could be simply a breakout test of the top of this wedge bear flag. Reasonable to put a stop here or here or here. In general, I would not put a stop there because the bottom of a buy climax, the bottom of a breakout, is a magnet, and the market usually tries to get below the low, and if it does, it usually reverses up. So for me, if I'm buying for any reason, even if I bought that close, I'll get off below the bear bar over here, or I'll rely on a wider stop all the way down here, looking to scale in. Market went sideways. We're still trying to get trend resumption up. And the bears reversed down here below that bar. And now they're reversing down again below this bar. So it's a micro double top and a double top. If you want, you can call it a triangle. A lot of the bulls who are still long will get out there. And a lot of the bears will view this as a trading range. This would be a second entry short at the top of a trading range. First entry here, second entry here. Bear bar closing below its midpoint, even though it's a doji bar, it's a reasonable sell for a scalp down. The bears who sold below this micro double top on the reversal down from the top of the range, the triangle, try to buy back their shorts somewhere in the bottom half of the trading range, and here we have a small sell climax and a bull bar closing on its high, bull inside bar. It's reasonable to buy above that bar. So this is a good location for the bears to scalp out. We have a bull trend, a bear break below the bottom of the bull trend line, You can argue it's a higher high major trend reversal, but it's only one bar, so it's probably not a major trend reversal. And then we have a lower high here, and it's a wedge. Do you see the three pushes up? Bull, bear, and then bull, bear. So it's a type of a lower high major trend reversal. Would I short that for a swing? Well, we're in a trading range and we're getting good reversals up and down. I think it's not a high probability swing short. In general, whenever you have any major trend reversal, you have about a 40% chance of actually getting a reversal into a swing in the opposite direction. Shorting this for a swing down, 40% chance you'll get it. However, here at the top of the trading range, you have a rally where the bull bars have bad follow through. It's reasonable to short, at least for a scalp. I'm going to talk some about bear breakouts now. E-mini, we had a bear channel and today gapped up, a tail on top but a bull bar. Then we have two big bear bars closing on their lows, breaking below the low of the past 30 or 40 bars. At the close of this bar, I think the market's always in short. It's a surprise given how small these bars are. The bars are very big, closing on their lows, always in short. 60% chance will fall for some kind of a measured move, maybe based upon the height of the bodies. That means from the open of the first bar to the close of the final bar of the breakout. If we had a third bar in the breakout, then it would be the open of this bar to the close of the third bar. But at this point, there's a 60% chance the market's going to eventually fall for a measured move down from this open to that close. So 60% chance we're going down here before we get back up here. If you had to do something, buy or sell, at the close of this bar, what would you do? If you sold, maybe you put your stop above the top of the two-bar bear breakout. You might put it up here, but let's say you put your stop just above the top of the two-bar breakout. And let's say you wanted to make a measured move down. You sell here. You're trying to get out with a profit here. Your stop is above here. The stop is about the same distance as the profit target. So the risk to the stop is about the same as the reward. Which is more likely? That the market will come down here to your profit target or go up there to your stop? If you can look at this and say, well, it's probably going down here. Anytime you can say it probably is going to do something, you have to assume you're talking about a probability that's at least 60%. And that is the case here. The risk is equal to the reward, but the probability is equal to 60% or more. And therefore, even though you're exiting with a reward that is as big as the risk, not twice as big as the risk, the trader's equation is still positive. Anytime you have a high probability event, a 60% chance or greater of getting a reward equal to your risk, mathematically, it results in a positive trader's equation. It's always okay to take that sell and exit completely here and have your stop up here. If a bull bought this close, his target is the top of the sell climax. And let's say he used a stop just below a measured move down. So his reward up to here is about the same as his risk. However, his probability is only 40%. He has a 40% chance of making a reward as big as his risk. Do you think that's a good buy the close bar? No, it's a good sell the close bar. The math is much better for the bears. The risk and reward is the same for the bulls and for the bears, but the bears have a 60% chance of making a profit, and the bulls only have a 40% chance of achieving their goal before their stop is hit. It's important to recognize things like this early. You look at this and say, whoa, wait a minute. The market was very quiet yesterday in a tight range, lots of reversals, and now it's very different. Now we're getting consecutive big bear bars. Once you see that, you have to be prepared to do the right thing, and one right thing is sell the close. In other words, like a second before the close, you sell the market, or as soon as the bar closes, you hit sell the market, and you get filled on the open of the next bar. The one thing that you no is you have to sell. And this is what happened. We got a bear breakout, a second leg down or a third leg down, one pullback, two. The swing bears are holding short with their stop up here, expecting the market to get down here, which it eventually did. It took 5 hours to get there, but it did get there. Scalping bears who sold that close might get out above this bull reversal bar because we have a double bottom and a failed breakout. So we have a trading range, we broke below it and we reversed up. This bar went above that bull bar, and then we're reversing up a second time. It's a possible low of the day, and we could get a bull trend for the rest of the day. And the bull's got a breakout here, 2-bar breakout. But look at the size of these 2 bull bars compared to the size of the 2 bear bars. Not all that big. This might be simply a test of yesterday's close. It might be a test of a 50% pullback. It's about 50% of the sell-off. Okay to hold short. The bulls need maybe 1 or 2 more bull bars or bigger bull bars to make it always in long. Therefore, it's always in short, which means you believe it's probably going to go down rather than up. The market kept trying to reverse up all day. However, it was a bear channel, and you have to rely on your stop. If you're a swing trader, you get out if the market clearly becomes always in long, but this is not enough to become clearly always in long. It's close, but not enough, and therefore you hold short. Is the bear breakout strong? I'm calling it a bear breakout. You can also call it a bear reversal. We gapped up and reversed down. We had a failed breakout above the top of a bear channel, and then we had a successful breakout below a double bottom. Every breakout is a climax. Every reversal is a breakout, and I treat them the same. Big bear bodies, both closing on their lows. That's a sign of strong bears. Very little overlap between the second big bear bar and the first bear bar. A close far below the low of the past 40 or 50 bars. Small tails or no tails on the bottom of the bars. Context, lower prices. We had a bull breakout that reversed down, and now we're getting a bear breakout, and we have a very strong bear breakout. The odds are we're going to fall for a measured move down. However, it might take hours to get to the target, and in fact it did. I think it's important to always be thinking about the market cycle. On any chart, only about 5 or 10% of the bars are in a strong breakout phase. Most breakouts like this or like this are 2 to 3 bars, not particularly big, and they're either in a channel or in a trading range, and not going to result in a strong trend. Only 5% of the bars are in a strong breakout at the start of a trend, like what we have here. Here we have about 100 bars on the screen, and we really only have 2 bars that are in a very strong breakout that resulted in a trend. Again, we had a bear channel. This is showing more bars to the left than what we see here. The bulls got a breakout above. They were hoping that it would result in a major trend reversal on the test back down, and instead we got a very strong reversal down here, and the bear channel continued. It's, I think, very important to always be ready to draw a conclusion. Is the market clearly always in long? Is it clearly always in short? And it's good to make that decision as early as possible. When you have this context, a failed bull breakout and then a successful bear breakout, 2 exceptionally big bear bars closing on their lows, the odds are we're always in short, which means you believe the market's going lower. There are all kinds of ways to get short. And again, especially on the open of the day, you have to be prepared for the market trying to determine the initial direction of the day. And here we have a very strong reversal down from breaking above the bear channel, and some bears would sell either at the close of this bar or below its low. For example, if you waited for this bar to close and you saw it closing exactly on its low, you might hit sell the market, and then you get filled on the open of the next bar. Whenever you cannot decide how to sell and you feel like, oh boy, it's going down, I got to sell, easiest thing to do is look where your stop has to be and just hit sell the market. Some bears will add to their shorts as it's falling. They're pressing their bets and they'll increase their position size. They're scaling into a winning trade. Some bears will sell with a stop on the break below yesterday's low, especially after such a big bear bar, betting that the market will fall at least far enough for a profitable scalp. Consecutive big bear bars closing on their lows, good context. It's a sell the close bear trend. So the bears will sell bear closes, the close of this bar, the close of that bar, the close of this bar, but they use the appropriate stop up here. We're trying to get a reversal, a failed breakout below yesterday's low. Would I buy that, hoping for an opening reversal up? I would want at least a micro double bottom, and therefore, even though it's a bull bar closing on its high, probably more sellers above the high of this bar than buyers. Also, anytime the market is making an attempt to reverse and you think the reversal will fail, some bears will sell the close of strong bull bars, like here, and like here, and like here, and like here, betting that all of these reversal attempts will fail and be the end of the reversal attempt and the start of trend resumption down. Again, you could bet that the reversal is minor and therefore a bear flag, and traders will sell above the high of the bar, even if it's a bull bar, betting that the market will fall at least enough for a scalp. Traders will also sell below the low of any pullback, betting that it's a bear flag and that the market will continue down. Here, a doji bar. After the bear breakout, we had a little bounce, the bear trend resumed, and then we have another bounce up to that same level. It's a small double top bear flag. If you want, you could simply call it a low one short, a pullback, and then a resumption down below the low of this inside bar. It doesn't matter which of the shorts that you took, you place your stop above the most recent major lower high. And if you sold anywhere in here, look to the left. Where's the most recent major lower high? It's here. And therefore, no matter where you sold, your stop is up here. The stop has to do with the price action, not your entry price. When the market's in a bear trend, it spends most of its time near the bottom of the most recent strong leg. Beginners, the one thing they always think about is risk. They're so afraid of losing their account, they tend to ignore probability and they tend to ignore reward. And the result is they end up using very small stops, and they repeatedly discover that they're getting stopped out of trends that go on a long way. When you're getting a pullback like this, who's causing that pullback? Is it institutional strong bulls betting that the reversal will be major? No, it's bears taking partial profits. Their stop is far away. They're taking some profits to reduce their position size. The reversal is probably minor, and the bears will sell again as soon as they believe the bulls have given up. Experts are selling for any reason. Beginners are waiting for a perfect sell setup, a perfect pullback, but it never is going to look good enough. Do you want to sell after two bull bars? The beginner does not. Do you want to sell after a reversal up from a micro double bottom? The beginner does not. Do you want to sell after this bull breakout? The beginner does not. But the experts are selling for any reason, betting that any of these reversals after a very tight channel will be minor, and that means there'll either be a bull leg in a trading range or a bear flag leading to a resumption of the bear trend. I began by talking about weak breakouts. I talked about weak bull breakouts in this particular video. Whenever a breakout is weak, especially if there's a deep pullback, bulls begin to wonder if the breakout will lead to a trading range instead of into a strong bull trend. They're still willing to buy the breakout even if it does look weak, confident that the first reversal down will be minor, which means either a bull flag and an immediate resumption of the bull trend, or the pullback will be deep, in which case a trading range is more likely than a bull trend. If it's a trading range, they can buy more lower, expecting it to get back to their first entry, where they can get out break even on their first entry and with a profit on their lower entry. I also began a discussion on bear breakouts, and once you think a breakout is very strong, there's a 60% chance it'll fall for some kind of a measured move before it rallies back up to the top of the breakout and hits your stop. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading breakouts. I think stop management is important with all trades. I'll talk about that for breakout trades today. And I also want to talk about different ways to sell. The market's obviously in a bear trend for most of the bars on this chart. And although the bulls broke above the bear channel, there was a very strong reversal down. And we have a pair of big bear bars closing near their lows. The market is clearly short, and the odds are it'll go at least a little bit lower. What do? You have to sell. The stop is obvious. No matter where you decided that the market is trying to go down, you know where the stop has to be. It doesn't matter if you entered here on this close and at the market here on the breakout below that trading range. At this close, the stop is up here at the top of the major lower high. By the close of this bar, everyone knows that the market is short, and everyone knows that the odds are the market's going lower, and everyone knows that the best stop is above the top of the sell climax, the bear reversal. You could put it above the 2-bar bear breakout. I would simply put it above the top of the entire leg down. You can look at that and say, oh my gosh, that's 15 points above. I can't risk that much. Well, if you cannot risk that much, don't take the trade. But if you are able to risk that much, then it's a reasonable trade, and you have to decide how to get short. There are many ways to do it. For example, you could sell the close, you could sell below bars, you could sell above bars, you could sell about a 50% pullback here. Once you decide that the market is going down, and you decide that you can use the stop, that your account is big enough, and emotionally you can risk that much, then you have to get short. If you wait more than a bar or two after this close, you should simply sell a small position at the market and put your stop up here, because the market may not pull back for a long time. Here it did pull back, but it might instead have simply gone straight down. One of the reasons that the market sometimes does go straight down is because of FOMO, fear of missing out. Traders are afraid that if they wait for a pullback, it might not come for a long time. If they sell, they'll probably make a profit even if it reverses on them, because the reversal probably will be minor and the trend will resume. And therefore, everyone selling at least a little bit can result in the trade simply working right away. And because you have the potential for a FOMO sell-off here, a very strong breakout, everybody knows the market's going lower, it's important, I think, to get short, either sell the close or sell for any reason. Obvious choice is you see the close of the big bear bar and you place a limit order to sell the close, or right before the close you sell the market, or right as soon as the bar closes you sell the market and get filled on the next bar. What's happening here? We've got 3 pushes down: sell climax, pause, sell climax, bull bar, sell climax, it's possible a wedge reversal. However, when the channel down is tight like this, the reversal is probably minor. If the bulls get a couple big bull bars, totally undoing this bear breakout, then they can make it back to always in long. But if the bars are smaller, have tails, and have bad follow-through, it's probably a minor reversal, and it will lead to a test back down to that close and maybe a resumption of the bear trend. It's reasonable to exit above the high of this bar. It's also reasonable to stay short and keep your stop up here. If you do exit, if you're a swing trader, you have to be willing to sell again, either below a bear bar here for a double top bear flag, or below a bear bar here, or a second entry short after this breakout, or the close of that bear bar, or now we have a double top here, sell below that bear bar. We have a low 1, low 2 below this bear bar. You have to be able to sell again. If you find that you get out of trades like this and are unable to get short again, and then you miss the swing down here, you have to think seriously about not getting out here and simply holding short and relying on your stop. A bull breakout, terrible follow through, and now a second entry short. A micro double top here, about a 50% pullback, a test of yesterday's close. It's reasonable to take the short. This is not enough to flip the market to always in long. Consecutive bull bars, not big relative to the bear bars, tails on the top of both bars, bad follow through, and then a second entry short. It's also a 50% pullback of the initial sell-off, and a lot of traders will sell here. Bull scalpers who bought here will be looking to take profits around here, thinking that the reversal up is probably going to be minor after a very tight bear channel. Probably the best the bulls get is a trading range or a resumption of the bear trend. There are lots of different reasonable stops that you can use if you sell for any reason. So let's say you sell this close. One choice is simply to use a money stop. You can say, well, that's 15 points. I don't want to risk that much. Maybe I'll risk 5 points or 10 points, or maybe I'll risk to just above a 50% pullback. At this point, a 50% pullback is around here, so you put stop a little bit above that 50% pullback. At this point, the 50% pullback is here. You can put a stop a little bit above that. The best stop, I think, for most traders is the obvious one at the top of the bear leg. Alternatively, you could put a stop above the top of the bear breakout. Chances are, if this is the start of a bear trend, like a spike pullback channel, it will not get back above the high of this bear breakout. And the price is not much different from using the top of the bear trend. So this is a reasonable alternative. This bar as well is another strong breakout bar, and if you're thinking that you don't want to risk all the way up here, that would be another choice for a stop. If you do get stopped out, you can always sell again. Whatever stop you use, the tighter it is, the less you lose per trade, but the more often you lose. If you use a very wide stop, you'll rarely ever get stopped out, but when you do get stopped out, you'll lose a lot of money. The key is to do something that is reasonable. If you use a tight stop, that's not reasonable. You're going to get stopped out all the time. If you use an extremely wide stop, that's not reasonable as well, because you're going to lose a very large amount of money occasionally. If you take 100 trades and choose among the reasonable stops, your profit will be about the same, whether you choose a tighter stop or the wider stop. Now, let's say you sold this close and you risked 1 or 2 ticks. Is that reasonable? Of course not. You're going to get stopped out 90% of the time and you're going to lose money. And let's say, alternatively, use an extremely wide stop, like 50 points, 3 or 4 times the height of this bear breakout. That obviously is not reasonable either, and you're going to lose money. Some traders prefer a high probability of winning and they'll use a wider stop. Other traders prefer to risk less and then sell again if they get stopped out. Let's say you sold the breakout below the trading range, or you sold this close, or you sold above this reversal, or you sold below this bear flag, double top bear flag, another low too short. Let's say you took that short. Let's say you sold this bull close betting against the reversal. Let's say you took the second entry short for the breakout above this lower high. It doesn't matter. Any one of these shorts, the stop is the same. It's the same trade. You're just putting it on at different times. A person who sold here and he held through all of this has the same trade as a person who did not sell here and instead sold here. They're getting in at the same price. The market has not done anything in the meantime to make them change the location of their stop. The stop is still here. Your stop placement has nothing to do with where you enter. It has to do with what the market did before you entered. And it's usually better to put your stop above the top of the most recent major swing down, because if you're betting on a swing, the market needs to get lower highs. If it gets above a major lower high like this, then your premise of a bear trade, a swing down, is wrong, and you need to get out. Strong breakout, especially to a new low. Traders lower their stop to above the most recent lower high. At this point, we have a strong breakout, new low. The stop goes above the top of the high. It's a major lower high. You can call it a bear breakout. It is a breakout. We broke below the trading range. You can call it a failed bull breakout. You can call it a reversal down after a bull breakout. It does not matter. Anytime you see a big bear trend bar, it's a breakout. It's a sell climax. It doesn't matter. You have a pair of bear bars. In this particular context, you can call it a reversal. We tried to break above the channel and we reversed down, but I would just call that a bear breakout. The market has another bear breakout here. It's reasonable to take the short, but where do you take the stop? It's a strong bear breakout and it's a new low. Is it a major lower high? Well, look to the left. You're still in a fairly tight channel. This is probably a minor lower high, and the most recent major lower high is up here. In other words, the market could get above this bar, and the market could still be in a bear trend. In this particular context, yes, this is a big bear bar, but it's still in this bear channel, and it's small compared to this bear breakout. I think this lower high is minor compared to this one, and therefore this is not a good location for a stop for a swing trader. If you're a swing trader, you're betting on a swing down, a bear trend. It's a bear trend as long as it keeps making lower highs, major lower highs. If it gets above this area, this major lower high, clearly your premise is wrong, and you don't want to be short, because if it gets above this high, your idea that we're in a bear trend is wrong. It's no longer a bear trend. It's either a bull trend or a trading range. In either case, that is not why you entered the trade. You entered the trade because you believed it was in a bear trend. And if it gets above this high, then you're wrong, and therefore you have to exit your trade. Can you get out above this high? Like I said, if you get out for any reason other than a clear reversal into a bull trend or the market hitting your stop, you have to be prepared to sell again because the market's still short. Here, a second entry short for the failed bull breakout above that minor high. If you sell below this bull bar, can you put your stop above the double top? You probably can, but it's probably better to still use the wider stop. Let's say after the close of this bar, can you put your stop up here? That's probably reasonable, but it's still a fairly minor lower high. We did not get a new low, even though it's a pair of good bear bars, and it totally reverses this pair of good bull bars. The market could get one more leg up and then a resumption down. If you do get stopped out, if this rally were to go above this sell climax and you got stopped out, you would still sell again on a reversal back down, as long as we stayed below the top of this bear trend. Here's another sell. Let's say you sold here. We have a micro double top, a bear bar. Let's say you sell there. We have a bear breakout, not particularly big. You might put your stop up here. The bull's trying to get a reversal, and now we've traded down about 10 bars. You might put your stop up here. You may keep it up here. All three are reasonable. If you use a tighter stop, like above this bear bar, or this bear bar, you're going to lose more often, but your losses will be small. It's reasonable to do that. I want to talk some about how to sell. Strong bear reversal. We tried to get a bull breakout. We gapped up on the open above yesterday's close and above a bear channel, and then reversed down very strongly. You could sell the close of that bar, even though it's at the moving average. However, that is the simplest thing to do. Just when you see the strong bear close, just sell the close. If you want, you could wait for another bear bar. At this point, it's a higher probability that we're going to fall for some kind of a measured move. Or you could wait for the bar afterwards and sell the close of that bar as long as it did not have a bull body. When I say sell the close, I mentioned a moment ago that it means different things. Some traders will sell at the market or with a limit order a second or two before the bar closes. Some will sell as soon as the bar closes, and they'll get filled on the open of the next bar. Some will place a limit order. As soon as this bar closes, they place a limit order to sell at that close. The risk is you miss the trade. If the high of this bar does not get above that close, you will not get filled. Here's an example. Let's say this bear bar, you thought, okay, we're going down. I'm just going to place a limit order to sell at the close of this bar when the next bar opens. So when this bar closes, you place your limit order to sell at its close, and look at the high of the next bar. It never went above that close, and therefore you did not get short. If you kept your limit order, this high looks like it's possibly above that close. You would have been filled over here. But that's your risk. In a very strong bear trend, sometimes if you place a limit order to sell at the close of a bar, the next bar will not get above your limit order and you will not get filled. At this point, and certainly by this point, the market is clearly always in short, and you have to get short. You have to do something to get short. And as I say, one of the easiest ways to do it is as soon as you see a strong bear close, just sell the market and use the appropriate stop. Sell the closed bears, strong bear bar, they just sell the close of a strong bear bar all the way down. They don't take all of these sells, but they take at least one. And some aggressive traders will add on as the trend goes their way. Let's say he sells this close, and then he sees the market doing this. He might sell more here, another breakout. He might add to his position here. He would be scaling into a winning trade instead of scaling into a losing trade. The important point is you have to get short, and all of these bear closes are reasonable entry places. You have to be very careful about a sell the close trend or buy the close trend that begins in the final hour. You have to be prepared to exit very quickly on a reversal. You can see the video on trading the end of the day for more information about what I'm talking about. Today is not an example of that. You could argue this is sell the close, and we're very close to the final hour. If you do sell that close, you got to make some quick decisions once you see it start to reverse. Sell the closed bears. They're looking to sell very strong bear bars, especially a series of very strong bear bars closing on or near their lows. And they'll continue to sell all the way down. Some will sell and then take profits, sell and take profits. Others will sell, and then once the market goes their way, they'll sell more. Most traders take one entry. They'll sell one of these, doesn't matter which one, and then just swing trade it. So if they sell anywhere in here, they'll put a stop up here, and then they'll just hold on. I had a friend, I traded with him for several years. In a market like this, he would just take a trade, and then he would place his stop, and he'd place a profit target, a measured move down, and then he would go out, and he lived on a lake, and he'd go out on the lake and row his canoe for a couple of hours, and then come back later. So he'd come back somewhere near here, and he'd say, "Oh, Al, I've almost reached my profit." Or sometimes he would have reached his profit, and he'd be back to flat. And he'd say, "Oh, well, it looks like I made money." I traded with the fellow for several years online, and I don't ever remember him once losing money doing that. And he'd go on errands, he'd take his mother to the doctor's office, he'd go to Walmart. He'd just disappear every day in the middle of the day. Once he sees what he thought was a trend day, he would place his order to get in, he'd place his stop, and he'd place a limit order to take profits, and then come back a couple hours later. Some traders sell every close. If they have a big enough account, they can just keep selling all the way down. I don't know anyone who has done that. One of my goals in life is to someday do that, just to keep selling, 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 and sell 10 times. I've never done it, but at some point in life, I hope to do that at least once. Why do you think this bar looks like this? Why is it a big bear bar closing on its low? It's because the institutions are selling, especially right before the close of the bar. They believe the market's going down and they want to get short. And they also want the bar to look bearish because they want other people to look at the chart and say, yeah, it's going down, I got to sell. Strong bear breakout. If you want, you can call it a bear reversal. A common problem is traders look at that and say, oh my gosh, I want to sell, but my stop is way up here. That's more than I want to risk. I'm going to wait for a pullback. But the problem, as I said earlier, is it may not pull back for a lot of bars. It may just keep working lower and lower and lower, and then you find yourself missing a huge bear trend. Your desire to reduce your risk, avoid putting a stop all the way up here, results in you missing the best part of a big trend. As soon as you think the market cycle has changed into a strong breakout, and the market's always in short, you should really force yourself to at least sell a small position if you can use the appropriate stop. If the stop is too far and it makes you too nervous, do not take the trade. Then wait for a pullback. Beginners are always looking for perfect trades. And the reality is nothing is ever more than 60% certain. If you sell this close, well, there's a 60% chance you're going to make a measured move down before it gets up here. And that's as good as it gets as a trader. And if you're trying to be a trader, you got to take the trades, assuming you can use the appropriate stop. If you cannot use the appropriate stop, don't worry about it. Do not take the trade, just wait. Again, if you cannot decide how to sell, or if you're taking 2 bars, 3 bars, 4 bars, waiting to decide, simply sell at the market and use the correct stop. For example, you sell the close and you say the stop is really far. Well, trade really small, but just get short. What about selling bear flags, pullbacks, like low 1, low 2, low 3s, wedges, triangles? You can do it for swing trades or for scalps. The probability is high enough for scalps if you use the appropriate stop, a swing stop. Here we have a resumption of the bear trend. We have a double top. You can call it a low 2, low 1, low 2. If you want, you can call it a low 1, bear trend down to here and a pullback, low 1. You can call it a low 2 here, low 1, low 2. Doesn't matter what you call it, it's a bear flag. If you take that short and then you see the failed low 2 bar right here, low 1, low 2, you could get out above this bar, or you could rely on your stop. And then here we have a bigger nested low 2, leg 1, pullback, leg 2, and this was subdivided into a low 1, low 2, and then this subdivided into a low 1, low 2. So it's a larger low 1, low 2. Again, it doesn't matter what you call it. The key point is it's still always in short. This bull reversal is small relative to the bear breakout, and it's simply a 50% pullback and a test of yesterday's close. The market's still always in short, and therefore it's still likely to go down. Another bear breakout, rally, low 1, rally again, low 2, another low 2 short. If you want, you can call it a triangle. It's a tight trading range. 3 pushes up, bull bar, and then bear bar. Couple bull bars, bear bar, bull bar. So selling below that bull bar would be a low 3 short, tight trading range, or a triangle. Here we went up, we went down, we went up again. We have a bear bar, bear inside bar. It's a low 2 short, low 1 below that bull bar. Bulls tried to resume again, low 2 here. Choose one entry, it doesn't matter which one. And once you choose the entry, you can always look to the left and find an obvious stop location. And it doesn't matter which of these entries you took, it's appropriate to use this stop up here. At some point, after a number of bars or a bear breakout here, you can lower your stop. When the market's in a very strong bear trend, a lot of times it'll have a series of low 1s before the market weakens enough to start forming low 2s. As trends progress, the pullbacks become more complex. So instead of a low 1, you might get a low 2. Instead of a low 2, you might get a low 3. And also the reversals tend to become deeper. Is this a major reversal? Probably not. It's a very tight bear channel. Even though it's a strong reversal, it's still probably minor, which means probably the best the bears get is a trading range. Very tight bear channel. The reversal is probably minor. Probably the best the bulls get is a trading range. And the bears will probably get at least a test back down to the bear trend low. This is the bear trend low. Reversal attempt minor. And therefore, bears will sell bull closes or they'll sell above bull bars, betting that the reversal will be minor and that either the market will go straight down or if it goes up, it'll come back down to the low later on as part of a trading range. Sell a breakout, betting that the breakout will fail to get very far up and the bears will win and the market will resume down. And you can sell above bars. Here we have a bull breakout and a pullback to a bull flag. The bulls want a measured move up to the high, and the bears are betting that the bull breakout will fail and the bear trend will resume. So you're selling above what you believe is a bad bull flag. Also, as I said, it's about a 50% pullback. Here's the top of the bear trend, the bottom of the bear trend. Here's a 50% pullback. Some traders will place a limit order to sell right there at 50%. Others will sell on a reversal down here or a second entry short here. You can also sell at a fixed number of points above the current low, like 1 point above, 2 points above, 4 points above, 10 points above. All of those are popular areas for traders to sell. This is 10 points above the low. Chances are the reversal is minor and will not get much higher than that, so some bears will simply place a limit order to sell 10 points above this low. You can also sell 10 points above an important close or 10 points above a high, like the buy signal bar high, thinking that the bulls who take the buy, if they get 10 points, they're going to take profits. When you see the market is clearly always in short and the reversal down is strong, the odds are you're going to get a swing down. This is so extreme, it might go sideways first, but the odds are we'll get trend resumption down. I think it's important to try to swing at least part of your position. If you keep scalping out, that's okay as long as you can keep selling again. One of the reasons why scalpers have a hard time making as much as swing traders during a trend like this is the scalper gets worn out. They'll take 1 or 2 scalps and they'll be too emotionally exhausted to get back short, and they'll end up missing a lot of the trade. I think the best approach for most traders in a situation like this is just use the appropriate stop, which is often wide, and hold short until there's clearly a major reversal up or a major reversal setup. In a very tight channel like this, all of these reversals are minor. In the final hour, after a channel is looking fairly weak, a lot of overlap, the absence of consecutive bear bars, big bear bars, you're probably going to get some profit taking. And therefore, it's reasonable to look to exit your swing trade in the final hour or near the final hour, either here or here, because a lot of firms are going to do that, and you could give back a lot of your profit if you keep holding. A 2-bar reversal, a decent buy signal bar right around the start of the final hour. We have a bear breakout below the bear channel, and we're trying to reverse up. It's still a minor reversal, but it could go far enough up to erase a lot of your profits at the end of the day. A lot of firms will be taking profits. Here we got leg 1, pullback leg 2. We're right around the leg 1, leg 2 measured move as well. We have a gap between this low and that high. Here's the height of the range, and we're right around a measured move down. Even though it's still always in short, it's reasonable to look to exit. We're at different measured move targets, bottom of the channel, final hour, reasonable to get out either here or above that bull bar. Even though this may be another bear flag and the market might continue down, this looks like a bear leg in what will become a trading range, and you will get profit taking at the end of the day in a trend that looks like this, a trend where you're lacking consecutive big bear bars, especially since you're at support. I began by talking about stops. If you're talking about a bear trend, you always want to put your stop above the top of the most recent major lower high. When you're in a bear trend and the market's clearly in a breakout and the probability is high that it's going lower, there are many ways to sell. And the key is, if you can look at the stop and say, yes, I can risk that much, then you have to get short. Certainly within a bar or 2 or 3 of you deciding that the market is clearly always in short. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading breakouts.